Hi, this is Krishnakant sir. Here I'm explaining about some of the concept regarding the INDAS 115. INDAS 115 is regarding revenue from contract with the customers. So here three words that I want to highlight, that is contract, customers and revenue. Revenue, how do we differentiate revenue from income? Income actually is the broader concept that may be considered as a bigger set for the subset revenue. Revenue just cover the income that is from the ordinary course of business, while income is the broader concept, as I have already told, that cover it's an every revenues, it's an every income other than including the income from the ordinary course of business. So in this 115 mixes the word contract that we are very aware of Indian Contract Act 1972, where the contract is defined as an agreement that creates enforceable rights and obligations between the parties. Next is the customer means the party who buys goods or services from an entity. Now what actually the objective behind the introduction of INDAS 115 was? The INDAS 115 have been introduced with effect from 1/4/2018, due to which there was withdrawal of INDAS 11 and INDAS 8. Now actually the objective was for determination of nature of revenue, timing of revenue, amount of revenue and uncertainties attached to the revenue, as well as accounting for the revenue. Now coming to the out of scope, what actually is not dealt by INDAS 115. There are a lot of revenue. As I already told, income is revenue that is from the ordinary course of business is only dealt. So there are the income like dividend income, interest income, that have been dealt by INDAS 109 financial instrument. And next, lease contracts, that is have been dealt by INDAS 116. Insurance contract have been dealt by INDAS 104. Similarly, non-monetary exchange transactions between the entities for facilitation of sale. What has to be noted is, for the facilitation of sale, just if there is an inventory exchange and that inventory has to be same, then only this comes out of scope from the revenue recognitions. Not understood here. So let me take an example here. Let me take an example for the two oil companies. Though both the oil companies are located at Delhi, one at Delhi and next is Kolkata. Kolkata has to deliver to its customer, that is who is located in Delhi, and Delhi has to deliver petrol to the customer who is located in Kolkata. So what they do is, instead of bearing transportation cost, they have a contract with each other for the inventory exchange, so that the transportation cost is also saved. So what actually here we need to understand, this is just the inventory exchange, and the petrol is the similar inventory in both of these. This is the inventory exchange, so this won't be recognized as per INDAS 115. But if I take another example, like G News and a physical newspaper, if G News asks the physical newspaper to provide the space, and in turn it provides the space for advertisement to that physical newspaper, so this though appear to be the similar product, and but it is not the similar product, as one is in online media and another is in physical mode. So this comes within the scope of INDAS 115, and the value of the consideration has to be considered while recognitions of revenue. So now coming to the famous 5-step model for recognitions of revenue as per INDAS. The first step is regarding the contract. Next is identifying the performance obligation, and then we identify the transaction price, then allocation of transaction price, and finally satisfying the performance obligation and recognizing the revenue. So what actually the first step deals with? Identification of contract is already defined. The enforceable rights and obligations between the two parties should be there. Actually the 5 conditions is there to determine to identify whether a transaction meets a contract or not. So it must be approved by both the concerned parties. Means consent is important for identifying a contract to be identified for recognition of revenue. Next is both the parties identified their rights and obligations, and next payment terms is determined in both the parties, and there is the certainty for the collections of revenue from the customer, and a last condition is that there must be the commercial substance for determination of revenue. So by following these 5 conditions, we identify a contract. The different 3 points that we need to concentrate while identifying the contract, that is duration of the contract and modification in the contract, as well as combination of the contract. When do we combine two different contracts? If there are 3 different conditions actually. If they are negotiated as a package, and single performance obligations has to be mentioned, and the price of one contract affects the price of another. affects another contract, then we need to determine them as as a contract, single contract, and we need to account for them as a single contract when though there happens modifications in the contract. And actually there are the three different cases that we need to understand. First is the goods and the services have been added. If goods and services have been added, then there are the two different cases, so we need to understand there. First is if goods and services have been added and they have been added at standalone selling price. If they are standalone selling price, then the way we consider that is a separate contract, and we recognize the revenue for that separate contract separately. But in case the standalone selling price, if they are not at standalone selling price or at price other than the standalone selling price, in that condition what do? We consider them as the modification in the contract, and we recognize the revenue on prospective basis. Points to be noted is here we recognize the revenue on prospective basis on remaining performance obligation for the remaining revenue. Next is model number 3 or type number 3, that is goods and services have not been changed but the price have been revised. So what actually has to be done here, we need to follow a cumulative catch-up adjustment. So what is this cumulative catch-up adjustment? We actually consider the percentage of the completion, as a date whenever the price has been changed, and we adjust whatever the change in the price is there with that percentage completion, and that also in retrospective way. So that is about the modification of the contract. Coming to the duration of the contract, IND AS 115 says that if unilaterally customers or entity may end their obligation and their contract, then we don't consider that as the contract and revenue won't be recognized as per IND AS 115. But in case both the customer and the seller are not in unilaterally format, and there is both the consent is required for termination, then we need to determine whether there is the penalty clause or not. If there is no penalty clause, we consider it as a longer shorter period of the contract, and if there is penalty, then we consider it is a longer period of the contract. So coming that all about the first step. Coming to the next step is regarding the identification of performance obligation. So performance obligation is what a customer has to perform, what an entity has to perform. Suppose an entity has made a contract to provide the goods or services, then in that case the performance obligation is to provide the goods and services. How do we define actually how do we count a performance obligation? There may be more than one performance obligation under a similar contract that has to be separated, so that we allocate our transaction price among the performance obligations that will be dealt in step 4. So how do we understand? For that two different things has to be noted. One is goods or services has to be distinct. When we consider goods or service to be distinct, actually three different conditions are there that has to be satisfied. First is if integrations is not required. Whenever we take the goods and services could be utilized on ideal form, we don't require any integration, or it is not highly interrelated with other, or not customized or modified, then we consider the goods and services distinct, and that performance obligation will be considered as a single performance obligation. So next come to the next step, that is regarding the identification of transaction price. How do we identify transaction price? What actually an entity is entitled from the contract to receive after satisfying the performance obligation, that is considered as the transaction price. So do we consider GST or in GST as transaction price? No. If that is under obligation for an entity to pay to some third party, that won't be considered the revenue as per IND AS 115. Now what actually the different forms of the transaction price are there? Actually we need to consider variable consideration, financing component, non-cash consideration, and amount payable to the customer to determine the transaction price, or to understand the concept of the transaction price. What actually the variable consideration are there? So whenever there is the performance incentives or price concession, rebates, refunds, discounts, incentives, penalties, these all are considered to be the variable consideration. So how do we determine this variable consideration? IND AS 115 says that there are two different methods to determine the variable consideration. One is the expected value method. By the word expected, we understand this is the probability. We just take the probability weight from the ranges of the revenue and determine the variable consideration. But the next method is most likely amount method. Whenever the answer comes in just two things, yes or no, then we go for this method, most likely amount method. Now come to the next concept of this same step, identification of transaction price, the financing component. When we consider that there is the financing component in there, whenever there is the difference between the transaction price and the selling price. To be noted is, if the difference is insignificant, then we don't consider that is the financing component. If the difference is significant, and also the transfer, whenever we have transferred the goods or services, and the payment made to the customer, there is a different time period lag is there, so then we consider there is some financing component over there. If we don't identify any financing component, it's okay. It's okay to say there is no financing component in the transaction price. Now there next is non-cash consideration. Non-cash consideration, in such a scenario, what we need to do is, for the non-cash consideration, what Ind AS 115 requires. Ind AS 115 requires that for non-cash consideration, we need to consider fair value as on the date of the contract, and once initial at the time of the initial recognition, subsequently whatever change in such non-cash consideration is there, we are not going to recognize that as revenue. This actually what Ind AS 115 says. Next is consideration payable to the customers. What actually we have to do here, we need to reduce this from the whole transaction price to determine our transaction price. So this was the step in DS. This was the step number 3 in Ind AS 115 for revenue recognitions, identification of transaction price. One, we may take an example. For suppose there is sales, and there is right sales with right to return. So what Ind AS 115 says, we need to recognize refund liability. We need to create a refund liability for the expected return instead of recognitions of revenue. So we may have a transaction entry as cash or customer account debit for the cash that we have received to revenue excluding the part that is our warranty expenses or the return one, as that has to be credited to refund liability. So, and next also the inventory, while crediting the inventory, we need to credit only such portion which are not returnable. Returnable inventory has to be debited and to cost of sales. Next come to the allocation of transaction price, step number 4. Step number 4 is regarding the allocation of the transaction price over the performance obligation. We have known the performance obligation in step number 2, and we, as I have already told, the also step performance obligation has to be determined, so that we need to allocate our transaction price over such performance obligations. So what could be the basis? What would be the basis under which we could have this allocation? The Ind AS 115 says that the standalone selling price is one of the basis of for what we will be allocating our transaction price. Now the question comes, how do we determine the SSP of every performance obligation? So there are actually 3 different methods that have been determined, that have been said by Ind AS 115. First method is market assessment approach. Market assessment approach, we may also say it is a proxy method, where we consider the market prices as our transaction price. And the second method is cost plus reasonable margin. Cost plus reasonable margin may also be considered within the internal factor, what we have incurred a cost and what is the margin that actually we want. That will be the method number 2, and the method number 3 is the residual method. Actually, for this also, as for this method, though I started at SSP, whenever the SSP is not available, then we go for the residual. We go for 3 different methods as per Ind AS: market assessment approach, cost plus approach, and residual method. But for the residual method, SSP of other goods and the services that is being provided has to be available, so only we can go for the residual method. Actually, SSP that we arrive is total transaction price minus SSP of the observable goods. What actually we need to consider in the step number 4 was this. Now let me come to step number 5, revenue recognition. So how do we recognize actually the revenue at step number 5? Step number 5 says that whenever the performance obligation has been satisfied, that is the customer has obtained the positions of the goods, customer is able to restrict some other persons to enjoy benefit of that goods, that is to say risk and the rewards have been transferred to the customer, legal title has been transferred to the customer has accepted the goods, then only these are the conditions that have to be satisfied before we recognize the revenue. So this was the 5 steps. Now moving forward, there are still some concepts that need to be determined before we conclude Ind AS 115. So as I have told, their risk and reward or control has been transferred. How actually the risk and reward control is transferred, that have been defined in Ind AS 115, that is maybe over the period of time or at the point of time. What actually happens if there is over the period of time? Over the period of time, if there is over the period of time, then we recognize the revenue on the percentage completion method. If you recall in AS9 also, we recognize the revenue for the services that goes beyond, that goes for more than one period on the percentage completion method. So the same is done on the over the period of time. This is also known as input method under IND AS 115. And at the point of time, we recognize the revenue at the whenever the goods and services have been transferred, that is at the point of time. So to determine the over the period of time, there are three different conditions not three different conditions that have to be satisfied. First is regarding the entity transfer the service to the customer, or and the customer is also continuously or simultaneously having enjoying the benefit of that goods or services. Next is entity which is constructing constructing that asset or goods or service that is under the control of the customer. And next, the third condition is that entity creates an asset for which it is having right to receive the payment. So these are the three different conditions, not cumulatively. Maybe any one of the conditions be satisfied, then we can say it over the period of time. So here, how to determine the conditions have been satisfied. Let me take an example. Whenever an audit is performed, that the performance have been done, what do we think, what actually has to be done if that auditor resigns and then another auditor has to reform or may continue from that process only? He has to reform each and everything. So it doesn't satisfy the first condition, which was that entity simultaneously, customer simultaneously enjoy the benefit. So in that case, in the audit case, customer doesn't simultaneously enjoy the benefit, so it is the service. So do we have to recognize on percentage completion method? Yeah, actually there was a third condition. That entity creates an asset without any alternative use. So audit has no any alternative use for the providing auditor. So and he is also under the right for receiving the payment. So we need to recognize the revenue on percentage completion method or over the period of time for audit services. So what would be the example for the first one? For the first condition that I have mentioned, that customer also get the benefit over simultaneously. So we may take an example of the voyage. Whenever the voyage starts, customer starts getting the benefit, that because once the distance have been covered, that need not be covered once again. So simultaneously entity customer start to get its benefit. So that would be the example for the first condition. So this was regarding over the period of time. So there are also the various situations that have been covered under IND AS 115, that was regarding the repurchase agreement, service concession agreement and others. So what actually happens for the repurchase agreement? Maybe there are the different types of repurchase agreement: future contract, call options or put options. For all this, what we need to consider is the selling price. What we need to look is the selling price. If our repurchase price is higher than that of the selling price, then in that scenario, what we need to consider the differences between is the financing component, and we need to recognize financial liability as per IND AS 109. But what in the case the repurchase price is lesser than that was original selling price, in that case what we need to do is we need to consider that as an agreement of lease, and that will be dealt over IND AS 116. So what in the case of the consignment agreement? When consignment agreement, it is in line with AS9. AS9 also says that whenever the consignee has transferred the good to the third party, then only the revenue recognitions will happen. So here is also the same case for the recognition of revenue. Next, let me deal with the bill and hold cases. Whenever the customer, on the request of the customer, entity holds the goods and that is separable from his other goods, and whenever the customer arrives to him, he is ready to, the goods is in the ready conditions to provide to him. So in that cases, in such bill and hold cases, even the goods are not under the control of the customer, but also it is at the request the entity has withhold such goods at its positions. The entity is allowed to recognize revenue. Now come for the service concession agreement. May I take an example that is regarding the build own transfer. Whenever a highway is being constructed, there may be the two cases. Either the either the constructor gets its revenue directly from the government or directly or has to collect over the period of time by collecting from the toll. If that's the case, that the constructor collects it from the toll, then he has to recognize an intangible assets to capital WIP. Whatever expenses have been made, that would be recognized as an intangible asset, and that intangible asset has to be amortized over the period of its contract. And whenever the revenue is being recognized, revenue is being collected through toll basis, that has to be recognized as revenue when and as and when it is being collected. But what happens if it is to be received from the government? In that scenario, we need to recognize a financial asset. How will be recognized? That will be dealt as per IND AS 109, and have to recognize a financial asset, and as an on yearly basis we need to increase that financial asset through financial income, that is the interest income. And at the time of final collections, whenever we make the final collections, we need to we need to have an entry bank on debit to financial asset to other income, whatever the balancing figure comes over there. So this was the concept under IND AS 115. So let me have a brief summary of IND AS 115. What I've dealt now, what I've said now, that was regarding the objective of IND AS 115. Next was out of scope, and then we came to the 5-step model. First was identification of the contract. Next was regarding the identification of transaction price. Next was identification of performance obligation, after allocation of the transaction price over the performance obligation, and lastly the satisfying the performance obligation and recognizing the revenue. What if we compare IND AS 115 with AS9? What new things have come? What new things have come was regarding IND AS 115 doesn't deal with the interest income or the dividend income. That I've already told. Financial instrument 109 will be dealing with these incomes. And the service concession agreement, which was not described in AS9, have been described in IND AS 115 also. For the AS9, it says that gross consideration or gross inflows will be recognized as the income, but here IND AS 115 says that the transaction price has to be determined, and that has to be allocated over the performance obligation for revenue recognitions. So I think I have added some value. I've added some value to IND AS 115. I have summarized IND AS 115 in a better way. If you like this, just request to comment.